Please ignore how I look like an absolute goblin right now. It is like 5 in the morning and yeah, I wanted to get this video done, so here we are. I'm going to start out with just some tips and then I will do 2 different examples. One that I think is more in line with what we would actually see on the exam, and then another more involved one. Just to go down this list real quick, these are the things that you want to keep track of when you are doing NPV problems on the CPA exam. First, map out the cash flows, whether it's a cash inflow or cash outflow. That matters because you are netting them together. That's the whole point of the net present value. 2, you want to identify relevant variables and information, especially if it is a more complicated problem that requires more calculations. Then it's going to be helpful to have things like the number of periods or the rate of return in a separate cell in Excel so that you can just point to that cell in your calculations. 3, a lot of the time it seems like they are giving us the present value factors themselves, so you really don't have to calculate much, but you do definitely need to know the difference between an annuity and just the single cash flow, because they tend to give both factors and you have to know which one you're supposed to use. So for an annuity, that would be if you did a project and then you were receiving the same amount of cash inflow each year from that project. That's when you would use the present value of an annuity factor. And I'll show an example where they give you those and it's calculated from there. And then sometimes if it's more complicated, they might give you like a salvage value at the end, in which case you would do the salvage value times the present value factor, not present value of an annuity, because you're just getting it one time at the end. And of course, the initial capital outlay in the beginning, the cost of the project, that is obviously just one cash flow, but you don't have to calculate anything there because that is the amount right now. So you don't have to factor in the time value of money because it's already there. The last thing on here is to use the NPV formula in Excel. And I honestly don't know if we would actually get any questions where we'd have to go that far to calculate this. It kind of takes a little bit of time to map it all out. So I don't know I feel like if there was going to be a question on this, it would probably be a task-based simulation. It wouldn't be a multiple choice, but I could be wrong. I haven't taken this section yet, so I'm going to know how to do it. Change of plans. So this video is getting very long very quickly, and I don't want to talk really fast and speed through this in case someone really doesn't understand it and they need me to talk slower. So I'm just going to do this one easy example in this video, and then I'm going to post a separate video with the more complicated one where you actually have to do a longer calculation in Excel. This is one of the AICPA questions I found about net present value for project. So you get to the question and the first thing you want to do, map out the cash flows. So looking at the problem, we see the initial investment is 3.5 million. It's kind of blocked out, but trust me, that's what it is. I like to type those as a negative because it's an outflow. All right, so then the cash flows for the next 5 years is 1 million per year. And 1 million per year is the same amount every year. So that to me sounds like an annuity. So number 2, there aren't really any variables we need to map out here. Mapping out the cash flows really did that for us. That comes more into play when you actually have to calculate the present value of each cash flow and then add all those together. But this is a very simple, basic problem on NPV. So we really can just cut to the chase. We mapped out the cash flows, and now we know that this 1 million per year, that is an annuity. So we want to find the present value of an annuity in 5 years. And that is right here, that 3.791. So this is just 1 times the present value of an annuity factor, which that's very simple math. You don't need to use Excel, but I'm putting it in here just to prove a point. So when it's more complicated numbers, you know what to do. Now we need to find the actual net present value because this is not it. None of this is the net present value. The net present value is these numbers netted together. So you can just do the sum of them. Because I actually put the outflow in as a negative number, you can do it that way. But you're really finding the difference between those. So the answer I get here is 291, and you got to remember that this is actually 291,000, and it's positive, which is good. That means that we want to accept the project. So we'll go to the answers, and usually I look for the value I calculated first in the answers, and it's usually a good sign if you see two different answer choices that have that value in it. That usually means that you at least have that part of it right. But here there's just this one. So we see answer C says accept the proposal because the NPV is 291, which is exactly what we were thinking and what we said. So then come down here and you can see that C is correct. So I'm gonna do a separate video with a more complicated NPV problem that actually goes through how to use the NPV formula in Excel. I don't know if we would actually need to go that far on the exam, but it's good to know.